Welcome back, everybody. Jay Martin here, CEO of Cambridge House, and my next guest is Jeffrey Snider, the Chief Investment Strategist at Alhambra Investment Partners. Now, Jeff has maybe earned himself the name over the last 6 months as one of the last deflationists standing. And so I really wanted to have him on the show because, as we've seen, headlines all over the world are calling for runaway inflation. And I wanted to see if Jeff could blow holes in this thesis. And he did a pretty good job. What he spent most of his time discussing was the lack of understanding of what inflation really is. So I thoroughly enjoyed this discussion. I learned a ton. I hope you do too. And as always, if you enjoy this, right beneath this video, there is a pinned comment where you can subscribe to my weekly newsletter. I publish a weekly newsletter where I talk about anything I've learned from conversations just like this, my biggest takeaways, all that stuff, and most importantly, where I'm putting capital in the market as a consequence of these chats that I have here on my YouTube channel. So pinned comment right beneath this video. You can sign up for free, and I'd love to have you join the tribe. But first, Jeffrey Snider, Chief Investment Strategist at Alhambra Investment Partners. I hope you enjoyed this one.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Jeff Snider, the Chief Investment Strategist at Alhambra Investment Partners. Jeff, how are you?
Good. How are you doing, Jay?
I'm good. Yeah, I just wrapped up a great week, and I'm in quarantine. We just got back from the US. I'm based in Squamish, which is between Vancouver and Whistler in Canada.
Yeah.
And my wife and I spent a couple weeks in the US. As of now, you still have to lock yourself up for a couple weeks when you get home. So
you're going stir crazy here and ready to get back to some kind of normalcy.
I have 3 kids under 5, Jeff. So
yeah.
Quarantine's
yeah, that's difficult.
Yeah. All right. Okay. So there's a ton of stuff I want to get into with you. Thanks so much for making the time. And where I'd love to start, you know what? The number one debate that I'm hearing on my channel with my guests, and that I'm seeing on my peers' channels and whatnot, other podcasts and all this stuff, is the inflation deflation debate, or sometimes it's the transitory versus runaway inflation debate. But that's where it is, right? And it's very easy to argue for inflation if you're a consumer retail investor, because you feel it in your wallet, right? I'm trying to build a shed in my backyard right now, and it's expensive, more expensive than it was a year ago, all this stuff. But, I question that thesis, and I know you do too. And so where I'd love to start is talk to my audience, Jeff, who is out at a dinner party tonight, and the inflation conversation gets brought up, and someone starts touting that we're facing runaway inflation. Could you arm my audience with a few points to combat that narrative?
Well, first of all, let's be specific here. What is inflation? And I think that's what's really lost in this whole debate is we don't even define our terms properly, because inflation is not a temporary spike in certain prices. It's a sustained rise in all prices. So yeah, I mean, lumber prices are up, food prices are up, but other things maybe not so much. And we're only seeing this over the last couple months. It's not like this has been happening year after year after year. And I know people will say, oh, food prices have been going up for a long time, but those have been balanced out by a lot of other things over the last decade or so, so that over the overall, inflation hasn't happened because there's never been a sustained background for it. And what that background is, where do we actually get inflation from? If we define it as a broad-based increase in consumer prices over a prolonged period of time, where does that come from? That comes from usually sufficient monetary capacity, money flowing through the economy, maybe even flowing too much through the economy, such that the economy then almost overperforms. It overheats. It gets too hot and goes too far. That's really where inflation comes in. And what we've seen up until 2020 was lack of money sufficiency. So we never reached full employment. We never reached maximum potential. I'm not just talking about the US economy either. I'm talking about a global shortfall in money and economy. And that's why we've had this disinflationary period for the last decade and a half. And so the question now is, despite the last couple CPIs in the US, does that represent a meaningful change in that underlying condition? Is a couple of months of really blowout CPIs really suggest that hey, this insufficient monetary background, that's all behind us. We've moved into some new role or some new paradigm where things are going to be very different from now on. And that's where you start to look around to all sorts of other clues that can tell you, or which one is it? Is this something new? Does this represent a meaningful change into something new? Or are we really just kind of a temporary spike in what is really the same kind of insufficient condition? And that's why we start looking at bond yields and all sorts of markets to try to tell us which one is it? Is it transitory? Because if it's transitory, it's not inflation. Or is this actually something else?
Yeah, that's a great answer. Thank you for pointing to the definition to start. And so, what I'd love to pull on there is when you say a prolonged period of time, can you give that a definition? What is a prolonged period of time?
It's sort of like the Supreme Court definition of pornography, right? We know it when we see it. It's hard to, a prolonged period of time is something more than a couple months, obviously. Yeah. But we're talking about several years. If you think back to the last inflationary period, which is in the 1960s and 1970s, it wasn't as if somebody flipped a switch in 1965 and the great inflation showed up. It sort of built and built and built and built. Inflation accelerated and then accelerated and kept going. So that by the time you get to 1970, 5 years later, it was obvious that it was an inflationary period. And it just kept going throughout the rest of the decade of the 70s. So that, you had a 15-year period where consumer prices were simply out of control.
Okay.
Now, does it mean that 5 years or whatever? We can't put a specific number on it, but it's got to be something longer than a couple months.
Right. So even if all the forces supported that thesis, you'd say it's too early to tell. You can't make that claim after just a couple of months or 6 months.
Yeah, the only thing I would say is that if this was an inflationary period, we're switching over out of disinflation to deflate or to inflation, it wouldn't show up like this. It wouldn't show up with huge spikes in consumer prices all at once. Those are more aligned with past historical episodes of supply shocks. 1947-48 is a perfect example where you saw the CPI in the US get up into double digits, but it only lasted for a little bit less than a year because it was based on non-monetary economic factors. It was based on supply constrictions related to the end of World War II and European demand coming online and things like that. So a supply shock kind of looks like what we see going on right now, and it doesn't look like this inflationary paradigm changing. The meaningful background behind everything has shifted out of deflation, the post-2008 deflation, into something different. So even the short-term stuff that has happened is taking the form of a temporary supply shock as it is.
Okay. Now, give me some examples when you say, yes, certain prices have been inflated, but they're balanced out by others. What are some examples? Technology services come to mind immediately. In terms of services that I purchased that have had massive deflationary pressure in the last 10 years. Does anything else come to mind, though, that balances out the rising prices we might see elsewhere?
That's usually where you see it in the technology space, right? And that's where you would expect to see it. Because everybody in their, in our lifetime, for sure, we've gotten used to the fact that anything technology related is going to get cheaper over time, because that's what really happens when we have a capitalist system adopting new technologies and then expanding their reach and their use. So that's an element of disinflationary pricing. And it's not the only one, but if we're talking about those types of things to try to explain why we haven't had inflation over the last 15 years, we're obviously ignoring the idea that there should be a monetary component behind this, which is monetary overflowing money supply throughout not just the US, but the entire world. And it's really, inflation gets to be a very emotional argument where people say, when I go to the grocery store, I see the price of meat has gone through the roof. Therefore, there must be inflation. But yet when they look at their Verizon bill or their, whatever the wireless data provider, which has actually gone down in price, they don't really notice that. No. They don't say, well, I think it's inflationary because I go to the grocery store and I pay a hell of a lot more for food, but yet I'm actually spending less per month because some other things have already balanced it out. And that's just human nature to look at things that way. 100%. And that's really you get into the argument about consumer price indexes and things like that. What is the right way to even measure inflation? And there's all sorts of debate and argument about whether or not we're actually accurately measuring CPI and consumer prices and things like that. But what I will say is that historically speaking, whatever the upside in consumer price indexes, you have to pay attention to them when they're low, because that low consumer price indexes or rates of change in consumer price index do correlate almost perfectly with periods of economic insufficiency. So there is a good comparison there, regardless of whether or not you think CPIs are illegitimately constructed or not. There is that phenomena where when they're low, things tend to be bad.
Yeah. Okay. I love that. Now, so you're right. It's absolutely human nature to notice the things that hurt, right?
Yes.
And if you're paying more for something, you're going to remember that more
especially when it's necessities, right? When you're paying more for gas, for example, or for food, it's something you innately notice that and feel that and say, "Oh my God, this is really hurting me."
Yeah. Okay. And then you brought up a great point, which I was kind of looking for, but outside of just consumer goods, what's happening from a monetary policy standpoint? And so, as you said, there needs to be overflowing money supply. And so talk to me about what's the relationship, Jeff, between money velocity and inflation, and what would we need to see to support that?
Well, even before you get to velocity, you need to get to the supply part, which is really the problem going back to August of 2007. This is the part people don't know about because, for most people think that the Federal Reserve is a central bank. It's not a central bank. It doesn't undertake the activities of a central bank. And if you actually listen to what policymakers say and what they do, pay attention to what they do, what you find out is, no, these aren't a central bank. They don't actually print money. Bank reserves are not money. They're a form of accounting. And so when you realize these things, you realize what's actually happening in the global monetary system, that it has broken down and stayed broken over the last 14 years. This disinflationary background makes perfect sense, because what happened in 2008 wasn't a subprime mortgage crisis that was temporary and fixed by QE. It was a breakdown in the dollar system, the global dollar system, that QE doesn't have anything to do with. And that's really, has that background shifted? Have we fixed the monetary system such that we can get into the possibility of inflationary money? And that's the answer to that is a resounding no.
Okay. And then what about wages, Jeff? How would wages have to factor into a runaway inflation scenario? And
well, you would expect that, when you get to full employment and maximum potential, or even going beyond maximum potential, what economists call a negative output gap, which is the economy's operating above its potential, therefore it's overutilizing resources. You would expect competition for things like workers as well as other things, and wages would accelerate dramatically. And that would help support the inflationary background, because that would be consumers deriving purchasing power from earned income. And therefore, as you mentioned before, velocity, money is circulating throughout the economy in the ways that it's supposed to. Yeah. But, again, that's not something we've seen at all over the past, decade and a half. And really, we can't tell now because we have such ridiculous comparisons to last year. All the data is sort of screwed. Sure. It's all skewed and screwed up. So it's really difficult to say, well, where are we now? That's why that's why I look at market signals to try to tell us what is actually going on in the real economy. You look at treasury yields, you look at the yield curve, you look at Eurodollar futures, the price of the dollars, exchange value, things like that. They give us a sense of what the monetary system is actually doing right now in the real economy, because it's situated next to the real economy. The stuff we can't see or directly observe, these prices are telling you what's going on there. And when you see interest rates remain very low, contrary to popular perception, that's a bad signal. That's not stimulus. That's a tight money signal.
Why? Can you explain that to me?
It's, Milton Friedman talked about this in the 1960s. He called it the interest rate fallacy, because we're all taught from the very beginning that low interest rates are stimulus. And that makes sense, right? I mean, it sounds like that should be that way. If it's cheaper for people to borrow, more people are going to borrow. But historically speaking, it's been the exact opposite. If you go back to the 1930s, the Great Depression, nobody would say the Great Depression was inflationary. It was outright deflationary, and it remained deflationary throughout much of the decade. What did interest rates do in the 1930s? They fell. They went lower. Conversely, what happened during the Great Inflation we just talked about in the 1960s and 1970s? Interest rates skyrocketed. They went into treasury yields went into double digits. So it's precisely the opposite of what you're told and what you're taught. When interest rates are high, that tells you that there's real money flowing through the economy. Because think about it this way. treasury, safe assets like US Treasuries, safest, most liquid assets, you're going to demand those things when money is tight. When the economy's not good and there's deflation all around, there's going to be a hell of a lot of demand for the safe liquid instruments. So prices on those things go up, interest rates fall. Conversely, when there's a lot of money flowing through the economy, there's nominal opportunities everywhere. You're not going to want to own treasuries. You're going to want to own everything else. So you sell those and interest rates rise. So when we see interest rates fall, and this is true across the world in any number of historical examples, that's a sign that money has been tight in the real economy. It has nothing to do with the Federal Reserve or monetary policy. It's the bond market, again, telling you what's really going on in the system. So lower interest rates, especially as they go low and stay low, think Japan over the last 30 years, that's a signal of deflationary background, monetary insufficiency, regardless of what the central bank is doing at any given time.
Yeah, that's interesting. And then I guess therefore from a supply and demand standpoint, it does make more sense the way you explained it just now to me. Because it's counterintuitive, as you said, cheap money. You would expect cheap money to lead to more lending, but
yeah, it's counterintuitive only because we're taught a different way, which is that central banks are central and they're omniscient and everything flows through the central bank. Once you get out of that mindset and realize that this monetary system has evolved outside of central banks, and then you realize the interest rate fallacy on top of that, this stuff starts to make sense. There really was no inflation puzzle over the last 13, 14 years. It was simply an inflation puzzle if you believe QE was money printing and the Federal Reserve was a central bank. But once you realize those things are not true, then it's, low interest rates, tight money, there's not going to be any inflation. It's just not going to happen. So as long as the markets continue to show and tell us that things are wrong, that rates remain low, tight money in the real economy, inflation is just not possible outside of these temporary deviations here or there. We get a little modest reflation along the way where, inflation rates tick up a little bit, but never go too far. And then they come right back down again. That's the most you can expect on this current tight money paradigm.
Interesting. And so do you think the factors driving people to talk about inflation, I mean, we're just talking about consumer prices, which sure they've risen, and strictly as a consequence of the world waking up from global lockdown, of course, supply chains are going to be a mess, right? You're not just going to turn the engine back on and things run smoothly again. It's going to take a year probably to work out some kinks. You think that's the main factor that's confusing people?
Yeah, that plus the money printing, right? Because, the Fed has gone crazy. Central banks around the world have gone crazy. And if you still think of QE as money printing, you think, well, all that that liquidity has to go somewhere. And eventually it's going to come out in consumer prices. So the people who have been screaming about money printing for the last 15 years are saying, aha, here it is. We told you, without ever explaining why it didn't happen up until now. But then you see, as you just pointed out, demand recovered much faster than supply did since the lockdown. Reopening allowed people to spend and do all sorts of other things. It wasn't so easy to restart production levels. In fact, you see it any number of economic statistics where spending numbers have outpaced production numbers. In the US, it's an extreme discrepancy. What that shows is that, as you just said, it's a supply bottle. It's a supply shock, which means that eventually supply is going to come back. And it'll eventually equalize at some point where prices of commodities like copper or lumber or all the major ones everybody's been screaming about over the last year, they're going to start to come down. And as we've seen over the last couple of weeks, lumber and copper in particular haven't just come down; they've crashed. They've crashed lower because this is behaving exactly like a supply shock. Which is, you could observe this in any number of ways, like any number of commodity futures curves that are in deep backwardation, which would only happen if supply shortages were real and very severe. So in every way, the CPI, commodity price behavior, everything else, it all looks a lot like the supply shock scenario rather than any type of meaningful change toward sustained inflation.
Okay. And then what about purchasing, Jeff? Do you think that as a consequence of not being able to purchase many services for the last 12 months, that theory that we borrowed purchasing power from the future for home improvements, for durable goods, for things like this?
Not just the future, Jay. I think it's also we borrowed purchasing power from services. And you see it in the US that in particular, service spending is way, way down because most people couldn't go out and do the normal things they used to do. So rather than go out to dinner, they sat home and bought stuff on Amazon. So they sort of cannibalized spending they would have spent on services for spending on goods. Of course, that fed into the demand for goods in particular and commodities coming back faster than supply did. Yeah. Because the service economy in particular was the most harmed by the lockdowns and the shutdowns. Therefore, Americans in particular, but not just Americans, Europeans and Japan and everywhere else around the world, they adjusted to it by, well, if I can't go out, I might as well go online and buy some stuff. And that's really what clogged a lot of these supply channels, was the fact that, we didn't buy as many services as we used to, but so we bought a lot of goods. But however, as things reopen, those things should equalize too. So people start buying less on Amazon and start going out more and doing things in buying services. That will also reduce the price pressures on commodities, as well as producer and consumer prices too, because demand will be starting to soften at the same time supply is coming back up, which I think is what we're already seeing in some of those key commodities like, as we said, copper and lumber, which is that we're just kind of normalizing after a period with everything just being so far out of whack.
This is just a reversion to the mean.
Yeah, sort of getting, coming back toward normal. Yeah. And that's, it's really understandable why people question, well, what is normal going to be going forward? Is it really going to be the same kind of normal as we had before? Is it something going to be something very different? Because on top of all these things, we've also got governments, directly spending money into the real economy. So you can understand why people would be a little bit nervous about, well, is there really inflationary potential with the federal government in the US in particular, just sending cash to people in large doses? That sounds like it would be inflationary too.
Sure it does.
Yeah. But when we look back at, Japanese example, for instance, what we see is that it doesn't matter how much the government spends or how directly the government spends, it still ends up, as long as there's that deflationary background, you don't break out of it. And that's really what we saw Japan in the 90s and 2000s, was tremendous doses of fiscal spending, a lot of it directly placed not to individuals, but to companies in the form of grants and things like that. I mean, huge, huge, huge numbers. And it still didn't change the deflationary background.
Right. Well, hey, I'm guilty on that Amazon front. I think I don't have to buy a book, Jeff, for like the next 6 years, and I'm covered.
Right. So you pulled forward all the literature expenses for yourself, and
100%. It's like every.
So there'll be a bookseller recession from here on out.
if anyone's acting like I am, 100%. Okay, so I want to pull back to a comment you made so that I can understand it better. And what you said essentially is people confuse QE with money printing, and that's wrong. And I'd love you just to elaborate on that a little bit for me.
Yeah, okay. So it sounds like it's money printing, right? It's something the central bank does, or what's called a central bank. It's what it does, right? It raises the level of bank reserves. And bank reserves sound like money. I mean, historically speaking, they've been treated as money. Some people consider them base money. So why wouldn't it be money printing? And the answer is that the monetary system had evolved into something completely different that the central bank, the Federal Reserve in particular, wasn't a part of many, many decades ago. We're going back into the 50s and 60s now, where the monetary system evolved to this Eurodollar offshore dollar exchange system where all sorts of different things were used as money and reserves. And in fact, you can even classify the Eurodollar system as a reserveless currency. It's a virtual currency. It's not an actual currency. And there's really no place for these bank reserves into it. And even when you look at bank reserves, you're only looking at part of the equation. Yes, you see the Federal Reserve Bank, its balance sheet increases when it does quantitative easing, but you don't look at the other side of that, which is essentially an asset swap. When the Fed engages in QE, it buys a bond that's already being held by a commercial bank. Mm-hmm. And so from the perspective of the Federal Reserve, its balance sheet rises. And if you think that's all there is to it, money printing, because it increased, right? But from the perspective of the bank, which is actually what matters, nothing really has changed. The size of its balance sheet has stayed exactly the same, except now it's swapped a bond for a reserve asset. And that's all that's changed from the bank's perspective. And there's a growing sense, as I've been saying for many, many years, that in swapping those assets, a bond for a bank reserve, that actually is harmful. It doesn't help liquidity. It actually harms liquidity because it robs the banking system of those bonds, which are used as primary forms of collateral and things like repo and derivatives. Those are the real money in the system, not bank reserves. So at most, you can say quantitative easing is an asset swap, for the perspective of commercial banks. And really, I think when you really get down to it and then analyze things on a very granular level, and the market certainly has borne this out. And by the way, I would also mention that a lot of central bank scholarship over the last couple of years has started to agree and say that this is the case, that QE actually harms liquidity. It actually robs the system of needed collateral that it can't get back in other ways, and causes dealers to actually have to adjust their balance sheets and their behavior in a very negative way. So there's every reason, first of all, to think, okay, bank reserves are just an accounting fiction. Number one, they aren't real money. Number two, QE might actually be more harmful than helpful. And that's why I say it's not money printing, because it isn't. It's actually just smoke and mirrors. And the reason I say that, because I can tell you want me to talk about that, is, look, when the monetary system evolved 50 years ago, 60 years ago, as a central bank, you say, I can't even define money anymore. What do I do? And the answer is what the Federal Reserve came up with, a lot of these other central banks came up with, is this what's called expectations-based policy. What it really says is, I'll move an interest rate around. I'll target an interest rate, the federal funds rate in the United States. I'll increase it or lower it based on how I want the system to respond. If I want to signal and I want things to tighten, I'll raise the federal funds rate. Now, how does that actually transfer as to tightening in the real economy? Central bankers have no idea. They don't know the monetary details because the banks have all taken care of those monetary details for so long. And so the idea was that as long as they signal to the banking system, what they want banks to do, banks would take care of the details. And therefore, if the Fed raises the federal funds rate, that would cause, essentially money dealer behavior to adjust in a predictable fashion, tightening credit in the real economy. But that's not really how it works. So really, you can understand why central banks move to an expectations-based paradigm. If you can no longer define money, you can't measure it, therefore you can't target it. Instead, if you target expectations, you're really just using sort of smoke and mirrors, and that's what QE really is, to try to get people to believe that you're in control. And that's, the idea of money printing has been around all this time because, central bankers know they don't print money, but they're absolutely fine if you think they do, because they believe that when they do QE, if you think they're printing money, that's all that matters, whether they print it or not, because you'll start acting as if they did. Yeah. If you think the Fed has printed a ton of money and that's going to be inflationary, you're going to act today as if that is true.
100%.
At least that's the theory. Of course, it doesn't really work that way, and it doesn't work out that way because 20 years of QE and no inflation or no actually success in any of those things. It just does. It's not enough to play upon people's expectations, especially when the monetary system, the banking system itself, is actually broken and harmed by QE.
Okay. So despite whatever investment gurus, financial media celebrities are calling for runaway inflation, what you see in the market, do you think the market is expecting inflation right now?
Not at all. I keep saying that the inflation case is the outlier, not the deflationary. The deflationary case continues to be the base case. And why I say that is not just the U.S. Treasury market, but all global bond markets. Yields remain incredibly low. And that's, again, a signal of inflation expectations as well as growth expectations predicated on the real state of the monetary system we can't observe. We can't look at this monetary system because, again, as I said, it evolved many years ago and, everybody stopped paying attention to the monetary details. So we don't really have any direct measures or data that tells us what's going on in the monetary. We have to depend upon these market prices and indication. And they are uniform in saying that inflation potential now is less than it was during the last decade, which obviously didn't lead into inflation. So if the markets are telling us this, and by the way, the bond yields in the bond market has been correct about all of these things far more than economists and bond kings and all these gurus on TV have ever been. Listen to the yield, listen to the market. It's telling you what's really going on in the economy and the real system. And when you see rates, look at the U.S. Treasury market, look at the JGB market. Despite the huge, massive CPIs over the last couple of months and all the stuff, the PPIs and everything in between, what have yields done in those markets? They've actually ignored those things entirely. In fact, yields have been sinking lower and lower ever since the middle of March, which is a pretty solid indication that the market is not buying this. This is actual inflation. In fact, I would say that the market is actually saying there's a hell of a lot more weakness in the economy than there is any potential for inflationary strength.
Okay. So therefore, Jeff, if I were to give you a 3 to 5 year time horizon, and ask you for the safest home for my capital, what would you point me to?
I would continue to point to things like U.S. Treasuries or whatever's closest to your home currency denomination. But you can also think of things like gold. If things get really deflationary, gold is not an inflation hedge. It's an error hedge. Deflation is one of the biggest errors. And I think that's a popular misconception about gold is that, it was great in the 1970s. Well, yeah, because the 1970s was a huge monetary error. It just happened to be an inflationary error. Okay. So if we have more deflation or worse deflationary errors, then we would expect gold to outperform, just like it had going back to 2018, 19, and 20 before COVID. Gold was going up not because inflation potential was rising, but because deflation potential was rising. The idea that Jay Powell had it all wrong in 2018, which he did, which bond markets actually showed, that 2019 wasn't going to be recovery. It was going to be more like recession than not. And that's exactly what happened. That's why gold prices tracked U.S. Treasury yields almost perfectly inversely. It was this deflationary error that was building in the system up until 2019 and 2020 before COVID was continuing. It was getting worse, not better.
Yeah. Okay, that makes sense. Now, same question, 3 to 5 year time horizon, but this time I'm looking for speculation upside. I want to be aggressive. Where would you point me?
Be aggressive. As much as I shouldn't say this, I would say crypto and things like that. That's one thing we haven't talked about yet. And I think that's one of the opportunities with crypto is that by and large, what's driving these bubbles in crypto assets and digital currencies is this mistaken impression of the Fed printing money, that they're devaluing the currency. And so every time you see this, 2017 is a perfect example. Bitcoin went parabolic because everybody, the dollar's crashing. Inflation's about to be unleashed. It's going to be awesome. And everybody piled into crypto for the wrong reasons. And of course, as soon as it was shown that wasn't the case, everybody piled out of it. Yeah. I think that's exactly the same thing that happened beginning last October. Dollars crashing, inflation's about to be unreal. Everybody piles into not just Bitcoin, but every kind of crypto asset there was. And so as it becomes clearer over the next couple of months, I think that that's not the case. The dollar's not going to crash. We still have the deflationary environment. The Fed didn't print any money. Everybody's going to pile out of crypto. And so there might be an opportunity to buy some of these things at a very cheap price simply because of this misunderstanding of what's actually going on. But because of what's actually going on, this tight money that's lasted since August of 2007, so going on 14 years, that's what's really driving interest in cryptocurrency. It's basically a form of elasticity that isn't being met by the private Eurodollar system because it remains unfixed. And so over time, I think what happens is there's value in these cryptocurrencies, if not for the reasons everybody seems to be buying them today. So there's a long run value in, I think, digital assets that, they're being wildly swung around by these misperceptions, which can create a lot of opportunities. And so if you're thinking aggressively, okay, so you have long-term value there, but, potential for a lot of wild price swings. That's where maybe you want to be aggressive, but wait for the cryptocurrency crash part 2 this year before doing so.
Interesting. I mean, that answer, the thread I wanted to pull on there was, do you think we're moving towards another, post 2017, 3-4 year crypto winter, as they call it, or will this be a shorter term correction? And you're telling me you're expecting another drop from present levels?
Yeah, I think we'll see cryptos go back down because I think, again, people have bought into them for all the wrong reasons. And the last thing you want to be is the greater fool. If everybody realizes at the same time that, the dollar isn't crashing, that transitory inflation, yeah, that was true. That was actually what was happening. Now inflation rates are coming down and all these other things. The dollar's not falling in exchange value. I need to get out of crypto. Because I didn't really know why I was in it in the first place. So there's that divorce between what's going, the long run value and potential, and these short run trends, which, the public, God love them, God forgive them for being, not understanding all these things because economics has done such a poor job of educating the public on what really happens. You can understand why people think I need to protect myself from a dollar crash because it's everywhere on TV. Everybody says it's happening. And then when it doesn't happen, you're left, I'm not going to be the one holding the bag, and everybody sells and gets out of it. So, it's two parts of the same story, which is cryptos can tell us something about what the popular perception is versus as they come back down, what's really going on, which is, the dollar's not crashing. It's actually more potential for going higher because of the continued tight money system.
Yeah. Yeah. And I wonder if it's more, as you said, economics has done a poor job of explaining what's going on. Maybe that, but simultaneously, the media has done a great job of sensationalizing any headline they can, right? And that's the business.
Absolutely.
Right? It's the financial guru business. It's clicks, views, subscribers on the back of you need to do this now, right? That urgency trend, right? And runaway inflation.
Yeah, if you're not paying attention, if you're just a regular normal person, as you would expect, you don't follow any of these things very closely, and you sort of get your news from headlines.
Yeah.
Over the last couple of months, what would you expect? That's what going back to last October when the crypto rise really started, it was, oh my God, the dollar's crashing. It's the end of the dollar's hegemony. It's everything's and that's all you saw across the media. Mm-hmm. And then of course the dollar stopped crashing and everybody switched to, inflation's coming. Inflation's out of control. Here it is. And you can really understand, why people are so confused and why they're so emotionally charged, especially going back to what we said out there at the beginning, where they're thinking the same thing. My food prices are going way up. Maybe this inflation stuff is real. I need to jump into something as a store of value to weather the storm, not realizing that what's really going on is very, very different than that.
Okay. Last question for you. It's more of a high level question, Jeff. Another common comment that I hear on my channel from individuals like Jim Rogers or Gerald. I'm forgetting his last name now. That's embarrassing. My viewers will know who I'm talking about. Anyways, is that the 20th century belonged to the US. The power is shifting now to the East. The 21st century will belong to China. Any thoughts on that statement, Jeff?
I think the Chinese will be lucky to survive the 21st century, to be honest with you. One of my major themes is that the dollar has harmed China more than any place else. Mm. The Chinese are aware that they're in a really precarious situation, and that is what's driven most of their politics over the last 10 years, so certainly under Xi Jinping's regime. Why that, for example, in the 19th Party Congress in 2017, Xi put his name in the Constitution next to Mao, saying, essentially, we're going to change how we do modern China. We're going to prioritize quality growth over quantity growth, which is a very different situation than I think people realize. And what it says is the Chinese are very aware that, economically speaking, in particular, they're in much worse shape than people maybe have a sense of. And so I think the Chinese know they're in a very precarious position, and that's why they're acting more and more authoritarian, because that's really what you do when you're in a top-heavy structure where you no longer have economic growth to keep people happy. And so without economic growth, top-heavy structure, what are you going to do? Well, you're going to start pointing your guns outward as well as inward. You're going to start making aggressive moves against outsiders as well as any sort of potential, potential dissidents inside as well. And it's really, to me, we put it all together. And there's obviously much more to this. There's a dollar component to it as well, right, which is basically the general thesis is China's in big trouble.
Okay. And then how much would you point to demographics as a contributing factor to that?
Absolutely. The Chinese absolutely hamstrung themselves by, the one-child policy, which they're now trying to desperately find some way around, but it's, obviously too late. By the time that even if they could be successful with encouraging, they're now allowing 3 children in some families.
Right. That's right.
Even if they could be successful with that, that's a decade and a half away before we even get some kind of a real legitimate growth spurt. And they got this next decade and a half in China, I think is going to be really, really interesting, to put it most charitably.
Okay. Look, Jeff, this has been fascinating. I'm really glad I had you on, and thanks so much for making the time. This was fun for me.
My pleasure. Always love to talk about hidden money and all that kind of stuff. And again, I think it's really incumbent upon people to realize that, economics is not doing you any favors. Just, start with the interest rate fallacy and start putting the world in that kind of a perspective. And things really do start to make a lot of sense. Realizing, of course, that most of what you've been taught is just wrong. It's just completely, utterly incorrect.
Most of what you've been taught and most of what you're sold. Again, because I guess I work in media, I don't know. And I watch sentiment, right, very closely. That's more where I live, right? And And half the battle, if not 90% of it, is cutting through the noise and getting to the signal, because there's just an abundance of bad information out there. Right.
Yeah, and the good part of that is that opens the door for opportunity for people like yourself to say, I'm going to do that. I'm not just going to tell you the same crap that you've been hearing all this time, because I think most people do know, even though they've been poorly served by economics and in the media in particular, they do know that something's not right. Even the people who are piling into crypto for the wrong reasons, they understand, okay, the central bank is doing something for some reason. Something must be wrong somewhere. So even if I don't know what that something is, I do know something's wrong. And I think that's why there's a tremendous push for answers, and there's a tremendous push into all different kinds of different media and things like that, because, we have been very, very well ill-served and underserved for a very long time.
Okay. Agreed. I love it. Again, thank you, Jeff. Thanks for coming on. It was great chatting with you.
My pleasure, Jay. Take care.
As always, if you enjoyed this content, please hit subscribe. I'd love to have you on the team. And if you want to take the next step and go a bit deeper with my content, I publish a free weekly newsletter every Friday where I debrief my portfolio. I distill the top lessons I've uncovered from the guests I've had on this show every week. And I talk about sectors and industries that I think are poised to move, areas that I'm looking for opportunity, and places that I'm allocating capital. I love writing it. We publish every Friday. The link is right beneath this video. Love to have you join the tribe.